Assalamu alaikum everyone, welcome back to another video. I hope you're doing great. So guess what, the only sector in the S&P 500 that's down a year to date is the healthcare. If you look at this, is the S&P 500, there's 11 different sectors. If you look at it a year to date, you can see the only one that's down is healthcare. The XLV is the only one that's down. All the other sectors are in the green. So utilities are about 10%, technology about 13% taking the lead in this one. Industrial, in fact, I didn't even think it was that good. It's about 17% up, 9% for financials, 2% for energy. Even energy was down quite a bit, but it's still positive 2%. 2.6% when it comes to consumer staples. Consumer discretion is another one that's not done well, and communication is doing really well overall. And the S&P 500, the index is about 8 and basically 8.6% up. So that kind of prompted me to look at some of the high quality businesses within healthcare that we could potentially add to our portfolios, or basically, buy new if you haven't already, or add to it if you've got it already. Now, the reason I said that is because one of the things that we'd like to do as people is buy stocks when they are trading in higher multiples and they're very expensive. So industrials are doing great, everything is going to the moon, and we just jump on the bandwagon and just everything collapses at that point. And that's not great. That's not part of investment. What you're supposed to be doing, and this is what Warren Buffett has done over the whatever years. If a companies are not doing well, then he looks at the intrinsic values of the business, analyze it. If he understands right now, Mr. Market is actually completely mispricing these companies, that's when he buys them. And then, of course, these companies will come back to, reverse to the mean, whatever. At some point, they will come back to their original, value, whatever, intrinsic values. And then that's when we make our money. And this is one of the reasons I would like to do this in this video today. Share with you guys 5 companies that are currently in the healthcare sector which are basically all undervalued at this point. Now, if you haven't joined us at the Patreon account, before we get to the video, please join us if you can. You can send me your subscriber portfolio portfolios, and then I will just send me a spreadsheet, and I'll send you a comment on by each one of the individual stocks that you own, and I'll kind of give you some of my opinion. Again, I'm not a financial advisor, but I'm there to help the community, and you get also access to the family portfolio and other things as well. Now, let's have a look at these 5 companies that we came here for. And the first one we're looking at today is Novo. Now, is no surprise, I'm sending this video as soon as I basically sent to the other one. So the first video I've talked about today was all about Novo. So if you're interested, go and find that video. You can see it's down 21% because a bit of news came up. But overall, let's have a look at the business. So I've done them, deep dive kind of video in the last one, so go and watch that one if you haven't seen it yet, where we talk about everything that went wrong and what we're doing with regards to this company, inshallah, in the long run. As you can see, company has a wide moat. The price right now $54 per share, dividend yield of 2.3. So these companies have excellent dividend yield, and a lot of them have a really good dividends basically, and also it's safe. Now, the payout ratio is only 48%. Latest increase was 22%. The 5-year growth rate of 22%, and the dividend streak of 28 years. Now, annually, you'll get $1.62. Safety, like I said, is 99%. That's the highest any company can get. Profit margin, return on equity, return on invested capital. You will not find many companies in the healthcare sector that will basically have this, even including Eli Lilly. Free cash flow right now will be looking at about $11.6 billion. EPS growth is expected to about 11%, Now, moving forward, because I'm recording this at the day where basically they came out and basically guided slightly lower when it comes to their revenue and so on, then that could easily change. But go and check that out for the video first. Revenue, we're expecting about 14%. Again, that can be slightly lower, but Morningstar valuation right now shows about 58% upside from where we are. $86 per share is where they think the price should be. The next one that we're looking at today is Merck, another one that actually reported, and I haven't looked at basically the whole financial report yet, but it looks like Keytruda was okay, but the other couple of the other drugs were down slightly. I think it was about 55% or whatever. Revenues basically were down. Sales wise, I'm gonna check it, inshallah, and maybe I'll share that with you guys again. But yeah, another one that's still basically undervalued. Basically 35% upside from where we are. Excellent dividend, almost a 4% dividend. We got payout ratio 40%, the latent 5%, the 7%. That's what we're normally looking for. That growth rate of 7% every single year. That's absolutely amazing. And then 13 years of increase in that dividend. Annually, you get $3.24. Dividend safety 90%. Profit margin, return on equity, return on invested capital. Again, really good business. Okay, free cash flow, well-run business if you like. Free cash flow up at $17 billion. EPS expected to grow about 9%. Revenue about 5%. Again, 35% upside from where we are, which is really good. If you think about it in the long run, that's the type of business you want to own. The next one is Abbott Laboratories. Again, another one that's undervalued. Seems undervalued at the moment. So I think it went up today after I've done the video. I think it's like maybe slightly up, but overall it's hovering around that fair value. Okay, the reason we basically use Morningstar valuation is always to be able to add another 5 to 10% on the top of that, depending on whether as a margin of safety on the top of basically that. Now this one you probably have to wait a little bit longer, so it's not currently really undervalued, but it's a high quality business. Okay, again, when it comes to this side of things, profitability side of things, when it comes to the management effectiveness, it's doing really great job. Excellent free cash flow. Earnings, they're expected to grow basically double digits, which is nice. Growth revenue for the revenue side of things is about 8%. And again, look at that dividend of just 1.8, less all, almost 2%, but 47% safety. Payout ratio, which means they've got a lot to improve. If they wanted to increase it for the next couple of years, they can easily do that without having to worry about anything. So really another great company. The fourth one we're going to talk about today is Thermo Fisher Scientific, the one that has been down a lot for a very long time now. $630 per share is where they think the price should be. Right now it's $482, so really cheap. The dividend basically yield is very low. The payout ratio again is very low because they're not spending a lot of their money on that. Basically, I think they're growing that dividend, but massively, but it's very low yield, which is absolutely fine, because in the end of the day, if you are after yield, this is not the company for you. Then you should be buying Merck and a couple of other companies. But with this one, is the yield might be low, but that growth is what we're after. That 16%, that's absolutely amazing. 7 years of increase in that dividend. $1.72 is what you get. 72% as well in terms of safety. Anything above 61% we say is very safe. Or safe if you like. Profit margin, return on equity, return on invested capital is decent. $6 billion of free cash flow. Growth expected to be, but in terms of revenue side of the 9%, revenue about 5%. EPS, like I said, 9% and then 5% here. 30% undervalued at this point in time. Before we get to the next one, please like the video, subscribe to the channel if you haven't. There's a lot of you that watch these videos regularly, but you have not subscribed to the channel. I would genuinely appreciate if you could do that, and also join us at the Patreon account where you get access to a lot of things, like I said at the beginning of the video. One more company, and then I'll show you from a Sharia-compliant side of things how to deal with these companies. Now, as you can see, is probably one of the biggest, like 400 billion market cap when it comes to J&J. Has a wide moat, so every single one of these companies has a wide moat. And then when we look at the dividend side, yield side of things, 3.1, payout ratio 50%, latest increase of 5%, 5-year growth rate of 6%. So it's slightly lower than we always say, 6 to 7%. But yes, that 6% spot is what we normally look for, 7%. I mean, the dividend streak is 62 years, so this is a dividend king as well as this one. These two are dividend kings. This one could have been dividend aristocrat, but it's not because of it's not in the S&P 500 and so on. The annually you got $5.20. The dividend safety 99%. Look at this profitability side of it. Look at the free cash flow. They expect it to grow, 5%, 4% basically when it comes to revenue and EPS as well. Now 2% upside from where we are. $172 per share is where they think the price should be. Right now it's $167, $168 per share. So again, on really great companies that are undervalued or almost undervalued at this point in time. What I will do if I were you, just to basically, especially these two, I own these two and I'm still buying them. Okay. This is one I will really like to own back again, but because of the legal situation, I'm not comfortable at holding it at this point in time. Now, with Sharia compliance side of things, as you can see here, all of these companies are absolutely fine, no issues with basically using these standards here that we normally use. Basically, I have no affiliation with Zoya, but of course, that I use that to make sure that the companies I share with you guys is Sharia compliant, and at least you are aware. Now, this is just to be on basically transparent with you guys. I'm going to show you the two companies that I have in this portfolio that I own right now. I own basically this company, about 100 shares of this one. If you have seen the last video, you will see that I actually bought more. Okay, and yeah, I'm down about 20%, or just £1,000, but 100 shares is what I needed. I got that. The next one is Merck. I think Merck, I'm in the green right now, just about how much? About 3%. Okay, 63 shares. Again, another one that I would like to get 100 to, inshallah, in the next few months while it's still cheap. But yeah, that's the companies that I wanted to share with you guys. I hope you enjoyed the content. If you are, please, let me know what you think about this. Do you own any other companies we haven't spoken about today that you would recommend for the community that we can check out? Just make sure, as long as it's Sharia compliant, that should be okay. I made some sales by today. I trimmed a few companies, so I'm basically kind of rebalancing the portfolio in the next couple of weeks. So I've trimmed a couple of companies and then added to a couple. So I will be doing a full video in terms of basically portfolio update, inshallah, in the next couple of days. I'll share that with you guys. Anyway, if you enjoyed the content, please like the video, subscribe to the channel. Have a wonderful day. Assalamu alaikum.